Okay, welcome in, you trader nerds. We have a new spreadsheet. The new spreadsheet is available to Muscadine Mafia members. If you're in our Discord group, you can try for 3 days and join the Muscadine Mafia and get the spreadsheet. It's the latest edition. Then we have a brand new trading plan that is available to all of our Discord members. That is 516. It includes the credit spreads / iron condors. It's got all of that in there. So, talking about rolling it. And then I put a little best practices down there that will give preference to credit spreads when the VIX is below 20 and undefined risk trades when the VIX is 20 or greater. I think that's our big takeaway from our weekend together with the crew. So apologize for being late. IHOP was taking a little bit too long on my steamed hash browns with no oil. It was really good. All right, so the market today is up again. Oh, be still, my heart. Look at this, though, y'all. This is what's amazing. The big green monster. Where does price go today? Look, I mean, it pinned our 0% line. How this thing continues to work and show us the inflection points are really, it's just staggering. I mean, so here's where you should have, sold your call spread or sold your call here, right? That'd been a great place to do that. But I don't know, just really cool. Really, really cool how that thing works. So yeah, we are overbought for the fair value zone below us. We still continue to think that we will fill in these areas probably over the next 10 days. We just don't know when, but we'll see. The linear regression kind of looks, upward trend, right? Now, what we see here, though, we got to go in here and start looking at these areas right here. See that? See where we've got all these areas that are right there? This is going to be a little bit of resistance in there. So we're close to resistance. So even though it may bust through, it's got to go through these little areas right here and pop through and continue to show that there's an upward trend. So it's kind of cool to see. Not that it matters for what we're doing, but the AD is negative now. How about that? Negative AD. And so we may see a little turnaround here, continuation. And the VIX is still at 16. VIX is down a little bit. So let's see how our little portfolio is doing. Now, yesterday, you see now we went from 96% probability profit to 85% probability profit because why? Bobby dabbled in the call spread. I just did. And I kind of like that too. Kind of like that. And that means that by putting on call spread, it brings my break even to the downside even farther down, which is kind of cool. So everything within a standard deviation looks really, 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 really good. So we are at 37,540, 37,540. Oh yeah, 37,540. Fire up the band, Rico.
Well, we're moving on now. To the side. To a deluxe apartment in the sky.
Hallelujah. All right, so we are at 4 delta. Look at there, we're delta neutral, 4 and 40. Let's look at that, 4 and 40. Oh yeah, beautiful. 4 there because we sold the call spread in there too. I think it was after I left y'all yesterday that I did it. So look at there. We're at 0.11. VIX at 16. That looks really good. And we are at 83.92. We're at 83.81. So nothing changed there. Beautiful. 83.81. So it's one of those days that you could put on additional risk, but why would you? I mean, why would you? We got this thing barking like a duck. This thing is making us money. Now, the problem with this account, you say this one's still down a little bit on the year. This is the one that we didn't take off all those Sweet Bobby hedges. And so now we should be finished with all those and we should be on the path to prosperity. We kind of got sidelined by that. But, live and learn. All right, so let's go to the IRA account, see how we're doing over there. Yep, here we are. And the IRA account is swimming along at 85,922. 85,922. Oh, yeah. 85,922. Praise the Lord. Hallelujah.
Well, we're moving on now. To the side. To a deluxe apartment in the sky.
Yes, Jesus. All right, here we go. 61. Oh, now I got to do a lot of math. 61 minus 27. I can't do that in my head. I'm gonna have to do this. I just can't do it. 61 minus 27 is, what is that? 34. So with 34.75. Okay, I don't want it bad. Look at that. 34.75. Uh-oh. Uh-oh. And we're at 16. So we're gonna have to do something here, or we're just not gonna make any returns. So we're at 25.61 yesterday. That's probably down a little bit today. Yeah, look at there, 19.340. So we got to do a trade, don't we? 19.340. Now, if I'm going to do what our amended plan says, we're kind of thinking, how many people do you go back on the linear regression chart? Let's see, it's a daily chart. Let's see, I'm not sure how many it goes back. Let's see. I just use their regular linear regression. Linear regression 100. So I guess that's 100 periods back, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 100. Or this might be 100. I don't know. But I just use their standard little thing. But, you know, it's really good at showing, you know, the overall trend of a market. And most of the time we are, you know, mostly range bound between the trend. But anyway, there is going to be a little bit of resistance right here. All right. So what do we want to do? It's a good question, right? What do we want to do? All right. So we need some theta in here. We think that the market is overbought. So we think that it could go down. Our deltas are a little bit positive. You know, it's kind of one of those days, if we're doing the defined risk trades, it's kind of like, I don't really prefer one or the other. Do y'all? No, I could, you know, I think I could do it on both ends. So let's look at that. You know, let's go over here, go to ES. And, you know, we're kind of following James here a little bit. And let's do a 10 delta on the bottom. So I go by probability of the money when you hear me say delta. So if we did a, let's say 36.25, 35.25, right? 36.25, 35.25 for $5. That'll bring in $250 worth of credit. See, how did Daddy know? Let's try that. Badingo, baby. Badingo. All right, so we got that one in. So, you know, maybe it's one of those things that you go, well, let's do one on the call side, see if we get a little extra. So we could go. Now, y'all remember, Tasty Research said, if you do anything with calls, we were basically talking about naked though, as long as your 10 delta or lower, you're okay. Now, I did test the 10 delta calls yesterday, and they didn't do as well as the 6 delta. So I kind of like where James has his set up at a 6 delta. So, you know, here's the same deal. We're already there, right? We're already at the, but can I do another trade here at the 650 and buy the 47.50, 46.57, 47.50? Sure, I can. That says I can't do that. All right, now let's do it. So we got 2 of those spreads in. So now let's go see what our overall, what did that do to our delta? I mean, to our theta. Now our theta is 80. Look at that. Just like, wow. Okay, 80. We bumped that up by 5. Okay. Rome wasn't built in a day. I don't have to get this anywhere near today. What did that do to our deltas? So our deltas now are 60 minus, that's the same, really, right? Same deltas. 61 minus 37, about the same delta. And our buying power is now 26.23. Let's see what our buying power did. Okay, we went up 1,000, 26.23. Right, so we went to 24%. Wang. Okay. So it's one of those things, you know, could I do a double batch of both of them? Yeah, I could. And that's why this account's underperforming, y'all. I don't trade big enough to keep enough theta in the boat. You see, I'm often blue in this account. You see, for days upon days upon days. but we're just now unrolling something. So I'm not too bad with that. Now I want to show you something. Oh, and I found my little thing that allows me to write. And I'm so proud of that because teachers, you know, those of us that are educators, we like writing. So let me write you something here. I'm gonna write you something and tell you what that damn thing's right. All right, here we go. Sign into my account. I'm gonna sign into my account. Wait a minute. Hold on. All right. Oh no, I got fired from the University of Alabama. I can't get in. They're like, we don't even know who you are, dude. Anyway, get my little whiteboard up because I want to show you. I kind of like I'm never making. Yeah, that was 90 days. It was actually 92 days, I think. So I want to show y'all why I think our plan is better now than it was. Okay. And I don't want anyone jumping ship and go, I'm all iron condors all the time. That's not what I'm saying. But I want to show you why I think our little program now is, God, if I can't get a thing, let me go over here. Where I can write. Okay, I just want to write. So what we have before, well, now here's what we've got. We've got diversity of strategy. You've got naked puts. You've got debit spreads, put debit spreads. You've got credit spreads on the put. You got call credit spreads. Now, what our program has is diversity of strategy. Okay, what we also have is diversity of DTEs. I'm doing my 111s at 60 days. Right? We're doing the credit spreads at 90 days. If you're doing some of your hedges that we allow us to do, some of those hedges we're doing at 14 days. So we've got diversity of strategy. We've got diversity of DTEs, right? And you know, do we have diversity of underlying? Not really, because I'm doing the micros and the E-mini. Some of you doing the E-minis and the SPX. I mean, it's all S&P 500 stuff, but I don't like diversity of underlying. That's the only thing that I kind of disagree with the tasty method of let's just trade everything. I don't want to trade everything. I want to trade one market, the S&P 500 that I understand. Now, you also, if you want to do diversity of underlying, do it. Trade this in gold. Trade this in crude oil. You know, you can certainly do that. No problem at all. I'm not going to fuss with you for doing this in diversity in passive income. Absolutely. We've got T-bills. I forgot about the T-bills. We've got 4 weeks and 8-week T-bills. We've got passive income stuff in this thing too. We've got a really comprehensive strategy. Now, let me go through, for those of y'all that are new, and tell you why we trade futures, okay? Futures trade 23 hours a day. Now, if you're trading SPX, you don't quite get that, but, you know, big deal. For those of us that trade futures, we basically get 23 hours a day. Not only that, but we get 1256 tax benefits. 60%, it doesn't matter if you hold it a day, or taxed as long-term capital gains, and 40% as ordinary income. Bobby, I'm doing SPX. SPX has that too. That's why we prefer it to SPY. Okay, SPX gives you that 1256 contracts just like our futures do. Okay, you have no dividend risk. Why? Because the futures don't pay dividends. If you're in SPY and you're short a call that's close to or in the money, you have dividend risk, and you may have to pay dividend for, you know, 100 shares for every call that you got in there. We don't have dividend risk. Another reason we trade futures is span margin. Now remember, span margin is that lady sitting at the end of the bar. She looks good, but you know she's gonna get you in trouble. It's best to stay away. Don't you go gear up to her and say, well, hello, ladies.
Hello, ladies.
No. You stay away. But with span margin, we dabble with her a little bit, knowing that she can raise her head at any point. But span margin allows us great leverage. We just have to be mindful of the buying power that we use on our span margin. So 23 hours a day, we got 1256 tax benefits. We got no dividend risk. We got span margin. We have no tweet risk. If you're trading Tesla, you kind of got to watch Elon's tweets, don't you? May get you in trouble. We have no earnings risk. Right? We don't care about earnings. We've got 500 stocks that we're trading in a single index or ETL. We don't have this earnings risk, and we don't have bankruptcy risk. If one of the companies goes out of business, they just replace it. It's not going to be the S&P 499. It's the S&P 500. If Tesla goes out of business, they're going to replace it with the next big up and coming. So we've got extended trading hours. We've got tax benefits. We've got no dividend risk. We've got span margin, no management risk. We've got no earnings risk, no bankruptcy risk. Anything else that I left off with our futures? I mean, there's so many advantages to trading futures, and that's why we do it. It's really a cool little thing that we got going on. So, just enjoy them. But a lot of people, I spoke to a lady in Atlanta, and I said, yeah, we mostly trade futures. She said, oh, no, don't be scared of them. Don't be scared. They're just like regular options on regular companies. And to me, they don't have as much risk as the as the individual companies. And you can go really small with the micros. So what we did is we increased this. I want to see this number go up until I get back to 0.10. So we went from 83, 82, 79, 80. We were at 75. I probably need to do a second tranche. Probably still need to. Let's see if I can get them filled for the same amount. I may do it. Let's see. Here's the call side. Okay, duplicate order. Okay, we got the call side in. Let's do the put side. Put. Come on, baby. Built the same price, so I can list you as the same thing. There we go. There we go. Hey, I got filled at 5 1/4. They updid me. Oh crap! That's gonna mess up my thing though. That's fine. I'll just list them as separate trades. So now what we've done is we've increased our theta to 85, almost 86. Let's call it 86. Hello there, ladies.
Hello, ladies.
Look at there. And I got it green again. And I need to do more of that in this account. Otherwise, it's going to underperform. However, this is an IRA account. And I may be a little less risk taking, I may be a little more risk averse in this account because it's an IRA. All right, let's go to the final account. So do you see how we've added diversification of strategy, diversification of DTEs? We've got passive strategies with our T-bills. I mean, we got it all, y'all. We've really got it all. So let's go to our Crimson account. This is the one that I can keep enough powder in to do really good. 35,937. 35,937. Look at this. 35,937. Praise the Lord. Hallelujah.
Well, we're moving on now. To the side. To a deluxe apartment in the sky.
Let's just stare at it a little bit, shall we? We're at 5.68% on the year. How are we doing compared to the S&P? We will overtake the S&P at some point. S&P's at 8.3. We're at 5.68%. We're catching them. We're going to get them. Don't you worry about it. The time is coming. All right. So let's look at our Greeks and ratios. Greeks and ratios over here are unbelievable. 21 minus 17. What is that? 4. So our deltas are 4 and 35. Because those calls are bringing us down. 35. Oh, yeah. We're at 0.10. We're at 16 here. So, you know, we could put on a trade. Let's see what our buying power is. Our buying power is a measly 7,069. What is that? 6,900 or so between those two. 6,900. So let's put that in there. 6,900 or so. Yeah, we're looking good. We can definitely do a trade over here if we want to. Right? Do we want to? Yeah, let's do it. Let's do kind of the similar thing we did in the other account. Let's go get it. Let's go. Yeah, 203. Let's get the puts done first, right? So this is the puts, vertical puts. Create duplicate order. Confirm and send. And let's send it in.
Bobby, why wouldn't you include the ES spreads buying power that you just put on into your overall buying power?
I thought I did.
I think you did. Didn't you take it out?
And I tried to put it in. Let's see. Let's go back.
Oh, I'm sorry. I thought you said like 7,100 minus 200 or something, and you came
Yeah,
out with...
I tried to use the MES 19 plus. Oh, did I subtracted it rather than added it? That's what I did, didn't I? Yeah, I did it right.
Right.
Yeah, I subtracted instead of added. Thank you so much. That's exactly right. So now we're at 21, what, 21.6 or so? Yeah, thanks, Victor, for bringing that up. 21.6. Wait a minute. No, that was in the other account. Let's see, 21.6. 21. Oh, 21.6. 21,600. There we go. Okay, so let's go back to this one. So now by putting on the put side, we did the Crimson account. So now we're at 38 theta and 8,000. Yeah, 7,000, 8,000. So 38, 8,000. Let's see what that looks like. 38, 8,000. 38 and 8,000. Oh, beautiful. Oh my gosh, that's good, y'all. Look at that. We're cruising along here. Let me just see if anything says we need to take it off. Let me clear this. Just look at our open trades. Just the ones that are blank there. All right, so let's see. No closing signals. We got a couple days left in our put debit spreads here, and our nakeds are, you know, now, what you could do too is go over here and start looking. You know, we're kind of thinking that on our, let me put these in some groups first. So that's a put debit spread or put credit spread. So add group, we're going to add a put credit spread. So let's look at our nakeds here. So we're kind of like letting these things get up to about 90% profit, right? Before we kind of start whittling those down, or 21 days. So you would think within, 8 days, we'll get close to that 90%. Now, I didn't put the 90% number in my plan. Maybe I should, hey, if something gets to 90%, look to close it. I probably should add that to the plan. Wouldn't y'all? Isn't that where we kind of finding that as a sweet spot, taking this off at 21 days or 28 days, isn't it? That's when we take these off. Oh, okay. 28 days or 90%. So maybe I'll put that in there, but that's kind of what I'm looking at. So let's see if that's my biggest one. Yeah, 75%. So tomorrow we should be starting to take these off, take a little risk off of our naked stuff. But I think I still want to put in that call side. I think I'm going to do it. Let's see what my deltas are. I want to keep a little bit. Let's go back to my deltas. Do I want to do something on the call side? 21 minus 6. So 22 minus 6. 22 minus 6 is what? 16. We're 16 positive 39. 1639. Let's go look at that. 1639. I don't know. We could probably try something. I think it works well. Let's go do the call sign. So let's go back to the other account. And field orders, call side. Here we go. So create a duplicate order, 245, confirm and send, and put it in the Crimson account. Beautiful. I said beautiful. There we go. Now let's look at our Greeks and ratios. So now we fill those. So we're at 21. Oh my gosh, I got to do this in my head. Let me just do this. 21.81 minus 6.23 minus 12.91. Is that right? Let me make sure it's right. 21.24 minus, yeah, I guess no, 6.23 minus 13.31. Okay, we're positive 1.7. I can do that delta neutral. I kind of like delta neutral. So we're 1.7 and 41. 1.7 and 41. And 41. And now our buying power moved up to doing those big trades in ES. We're at 7,000 plus 1,100. So that's what, 8,100? God didn't add anything, did it? Ta-da! Beautiful. That's how you run a portfolio. Any questions or comments? I don't want you to think I'm abandoning strategy, but what I think our big takeaway was low volatility environments. Maybe if you are better doing a little more defined risk trades. Okay. A little more defined risk in lower in volatility environments. Now you've got to decide what's a lower volatility environment. Is 16 low or is that normal? I would contend that the average is around 17 or 18 on VIX. So what my plan said, let's go show it to you in the plan so nobody thinks I'm making it up. I put on a best practice preference. It doesn't mean I have to. I can still do 111s and 112s, but preference is given to defined risk trades when VIX is below 20 and undefined risk trades when VIX is 20 or greater. Now, the cool thing is, check this out. If I want to, right, I've got enough theta to burn if I want to, I can still put on my put debit spread. How about that? You know, you could say, hey man, I can still do put debit spreads. Market's up today. What a great time to put on the put debit spread. So don't abandon the put debit spreads, even if you're doing the defined risk trades on the put side. You can still put that on. Now, do I have to put it on? I don't have to. All that we're getting back to is this. Here's where the decisions are made. We're trying to keep ourselves relatively delta neutral, right? We don't want to be plus or minus 54 deltas either way. So we're right smack dab delta neutral. You want to keep your theta at 0.1% of your net lick or a little higher, right? We don't want to go above the 0.2, but we're trying to keep things at 0.1. And you're trying to keep your buying power constrained. How wonderful it is to look at a portfolio and to see everything green. Now, is this a guarantee that you and I are going to make money? Oh, heavens, no. No guarantee. But we've got the probabilities in our favor. We've got high probability trades. We're keeping ourselves relatively delta neutral. We're monitoring our theta. So you sit there and you go, okay, our theta is $41. Okay. So theoretically, $41 a day times 365 days is $14,965 of daily theta or yearly theta that we'll have, right? Divided by 36,000 is where we're at, right? So you would say, oh man, that's a 41% annual return. Okay, yeah, if we can keep that entire theta Tasty Research says that you're going to keep about 25% of that. So that's 1025 a day times 365 days is 3741 divided by 36,000. You know, that's 10.39%. Okay, you're probably outperforming the S&P 500. I think though that we're going to, based on our management, we're going to be able to keep more than the 25% of our theta. Do I
Bobby,
know
I
that?
have to jump in.
Absolutely.
I don't think Tasty is saying you're keeping 25% of theta. I think they're saying you're keeping 25 out of, let's say you're shooting for 50% profit,
Mhm.
but you're keeping half of that, roughly like that. I think they're not saying you're keeping 45% of your daily theta. But either way, it's somewhere in there, but I don't think it's exactly 25% of the daily theta.
Okay. Okay.
Which would mean it's more than that, basically. It's definitely more than that they're saying.
So based on my statistics, now y'all, I'm gonna tell you something. I did this spreadsheet a long time ago. Hey, you're exactly right. This is without taking in the T-bills. You're exactly right, Avi. We hadn't even thought about that. You know, we ought to be making another 4 or 5% on our T-bills at the current rates, right? So we're kicking. And what this says, this would turn in actuality be true based on how I've done so far. It says I'm on return for 16.2% this year. Now I know that's disappointing to some of y'all. You're like, screw that, 16.2%. James already up 15% on the year. I got it. But historically, 16.2% is a wonderful return. And whereas I said that Tasty says we'll keep 25% of our premium, we kept 22.66. Why is that low? Because we closed out some of those trades during the Bombageddon. Why did we decide that defined risk trades are better in a low volatility environment? Well, it's because you're not influenced by the Bombageddon. So everyone needs to understand there's been a lot of discussion. The gathering in Atlanta was so good and so important. And if you can come to our next gathering, you know, I don't know if we're going to have one in the fall or we're going to wait till next year. I don't know when we're going to do it. But if you can come just sitting around with people who are good, you know, good traders like Trey, James, and so many, and Ed, and so many that, and John, and I mean, I keep going on and on that came, and just hearing, hey, you know, it all started with, yeah, you know, the vol increase really didn't affect my positions much at all. What? Why? And that's when we started looking into it. So projected weekly profit, we're on target for $111 per week. We've sold $7,400 of premium. We kept $1,700 of that. We're staying in our trades an average of 41 days. So it just kind of tells you our win rate's 47% because we're losing 100% on those put debit spreads. And we're taking profits on our naked trades. This was up to like 70% or more. And this should go up as well. I expect all of this to go up if we are not affected by the Bombageddon as much before. Oh, let's look at this spreadsheet and see if it works. Let's see if this works. All right. So we had well, I need to go to my account statement and my trade I did it yesterday too. Okay. So yesterday, let's see, 511, 517. Okay, so we did a vertical spread yesterday. We did a 46.50, 47.50 call spread for $2. All right, y'all remember that. 46.50, 47.50 for $2. Let's put that in. Lord, who's calling me? From Atlanta, Georgia. Mr. Gaines, Ed's room was destroyed. We're holding you personally responsible for Ed's shenanigans. All right, so here we go. MES. We did one contract yesterday, and we're going to call this a call credit spread 1, right? And we said it was the 46.50s, 47.50s calls. Dang it. Damn it. Calls, and it was a credit spread. Let's see if this thing works out. And it was at let's see, trade, we're at 92 today, so it was 93 days yesterday. 93 and 5/17/23. So we were in at that for $2. So we should have collected a credit of, that don't sound right, $7.06. Oh, we were in EF, sorry. There we go, 96.36. Let's see if that actually worked. Please, God, let this work. I've already released a stupid spreadsheet. All right, so let's see. 96.36. Create duplicate order, $2. 96.36. Oh, thank you, Lord above, for that. Okay, that's good. All right, so we got that in. So now let's go and do these orders. So we did a put side, 36.25, 35.25, 36.25, 35.25, 36.25, 35.25 for 5 1/4. 5 1/4. We did that in ES. So we've got diversity of underlying. I mean, they're related, but so this was a put credit spread 1. Right? And we did it on put side, credit spread, 92 days, 5/18/23. So now why ain't that working? Why the hell ain't that working, for God's sake? Here it was. Come here, little buddy. Why ain't that working? ES, put credit spread 92. We got 5.25 in. Why ain't the formula working, Bob? There we go, 258.86. I'm not sure why that did that. So let's make sure that's we're testing our spreadsheet. Muscadine Mafia members get to 258.86. Yes, thank you, Lord. Thank you, Lord. Okay. So everything's working good. So let's put our final trade in. And we did a 46.50, 47.50. Look at this, y'all. Yesterday, we did that same exact spread for $2. Today, we did it for $2.45. Isn't that great? So $2.45.
Hey, Bobby, what buying power does that use?
Yeah, we'll see that in a little bit. Let's see what that did. Okay, so 1, and we did a call credit spread 2, 46.50, 47.50 calls credit spread, 92 days, 5/18/23. Dang it. Okay, so we got 118.86 out of that one. So we got better than we did yesterday. So you will see particularly that one trade, or what all three of these have done.
Just that one trade.
This last one here, this call spread. If we were to put that on today, buying power effect, it says 0. And I don't think that's exactly right. Let's see. We could see. Let me go to the Analyze tab. Analyze. And let me get rid of this.
Maybe it gave you 0 because you already had a put spread, so it didn't want to charge you again for the.
Yeah, maybe did. Okay, maybe this is more like it, right? $1,200 on that.
So
Buy sale.
you said that put credit spread was $1,200 and it will bring in roughly $100 of profit.
Uh-huh.
So about $90 of profit over if you get out at 90%. So say $90 over the next month or so. I guess my big question here is that really worth the extra buying power in comparison to like the naked options? It just seems very inefficient, right? It seems like we're paying a lot for protection when our MES positions would bring in a similar amount for a lot less buying power.
Here's the cool thing, Evan. Look, so now we've got 3 positions on of the credit spreads, right? So we've got 2 on the call side, 1 on the put side. And it looks like the entire 3 trades are only taking up $1,100 in.
Right. But you also have extra long puts in this portfolio, right?
I do not. I've got put debit.
Well, they'd be in the ES on the bottom, right?
I don't have any there. No. I've only got 3 credit spreads. There's
okay.
there's no long puts. Now, you mentioned on these, Evan, taking them to 90%, but I think what we're doing on these is we're going to take them in 45 days or 40% profit, whichever comes first.
So you're tying up, you're comfortable tying up that much buying power for $40? I mean, if you put it on for, it should bring in, you brought in about $100 of credit, and if you're going to take it off at 40%, then you're looking
let's
at
see.
tying up $1,200 of buying power for a month and a half.
Plus 258.86 plus 118.86 equals 474 times 0.4. So we're bringing in $189 of profits, what we're looking at for those 3 trades.
Okay, yeah, I was just
Plugged it
basing
in.
it off of what Matt asked about, because he said, what was the buying power for that one trade? So
Gotcha.
I just plugged it in
Right.
on Thinkorswim. I don't have any positions at the moment. And I did the 34.20, 33.25 for 92 days.
Mhm.
That's max profit 137.50. Uses $421 buying power.
Okay. On the call side, right?
Well, that's on the put side.
On the put side. Okay.
How are your numbers so different then? Because if Bobby's at 1,200 and you're at 400, I feel like there's a big discrepancy there. And you're both on the put side in the same expiration. That's kind of,
Well, there are 2 call debit spreads and only one, put credit spreads and 1 put. So there's more buying power being taken for that extra call credit spread, I would assume.
Let's see if I add the put by itself again. Let's see what it's saying. Okay, so the put credit spread is $625 based on everything that I've got in, right? So I mean, to me,
I just
bringing
plugged it on the call side. The 4,600, 4,700. It's
Mhm.
$1,251, $1,200
Okay.
to be on the call side.
So, and again, it all depends, I think, on what our existing positions are, right? They're taking into account how they're doing all this. So, you know, for me having 2 call positions and 1 put position, you know, they're charging me $1,100 of buying power. And so if I'm going to bring in 40%, that's what I'm looking at, bringing in $189, 40% of the premium that I've sold, you know, that's a 17% return on capital.
yeah, that looks a lot better than the initial
Yeah,
use 1,200 to make 40.
right. Yeah.
Can you do the calculations real quick on the 111? I want to say we,
Mhm.
oh gosh, what is it? About $100 that we would traditionally bring in for the full 111.
So we normally bring in $100 for the naked part. Let's see where we did one. A put date spread. Okay, here we go. So 36. So we brought in $100 and we spent out $50. So we're bringing in about $50, right? On a 111.
Yep. So $50 on the 111.
Uh-huh. And
I'm
what is that?
going-
It's about 800, isn't it?
I'm looking really quick because I don't remember exactly what it was. So that, and then sorry, trying to be quick here.
No, you're doing great. What great discussions we have. This is amazing. I don't know wherever else you can do this.
That, just grabbing a naked real quick.
Mhm.
That's 10. and 20. So I'm looking at $454 debit right now for a 111. A 112 would be about 900.
Mhm. So
So
that's
I
an
think-
11% return on capital with the 111, but that's not taking it at 90%, right? That's taking it at, if you made your full $50, that's 11%. So
Right.
90% of that is $45 divided by 454. $45 divided by is 10%.
But that would be coming off at 21 days no matter what. So
Yep.
we're looking, well, I guess 39 days versus 45. So yeah, pretty similar. Okay.
Yeah. So about the same amount of hold time, right?
About the same hold time. The Iron Condor looks, I guess you could argue, more capital efficient.
Mhm.
Yeah, okay. Interesting.
It is interesting. Now, I'm not saying it's the be all, of all things, and we shouldn't, just go straight to it and forget what we were doing. And I even like still putting on put debit spreads at times, to have that little bit of downside protection. I just think I think the cool thing that James figured out and we figured out is regardless of what he's doing and what we're doing, he's keeping the same amount of theta that we're keeping in doing what he's doing. He's still got the 0.1%. So the only advantage that he has is during the vol expansion, he didn't experience the volatility in P&L that we did. That's the only difference.
But going 111 with only collecting twice as much as you're paying for debit, it's very conservative, and I would imagine you would have a hard time, catching up. I'm assuming this is the account that's underperforming a little bit if most of the trades are like this, because you're spending a lot of, like mine would be almost double. I would be doing 200 for 50, and then the capital efficiency would be better. Obviously, I would have more positive delta and be taking a little bit more risk, but this, I think it's hardly sustainable, 100 and paying 50. And by the time you take it off, because you are not taking off the $50 that you pay for debit spread, but you're cutting short on the naked, so you're not even collecting 100, but paying 50. So
Right.
uh,
Yeah, I mean, I think the credit spreads give us bigger bang for the buck. So what I would say is if you're doing the 111 and you just want to do the credit spread on the put side, maybe move up to ES, do them 100 point wide, still do the put debit spread with it. You don't have to change anything. You don't have to do anything on the call side. You're now just doing your put debit spread in the micro and doing your income trade on the E-minis. We're certainly bringing in a lot more credit. Look at this. 258 credit compared to $98 on the naked put. Definitely.
But you're also
bringing in-
taking it at 40%. You're not holding it to 90.
That's true.
So you're not really taking in
So 98
anymore.
times 0.9, we're looking at bringing in $88, right, on that trade. And over here, let's see, the put spread, 258 times 0.4, 103.
I mean, almost the same amount.
Mm-hmm.
And it really is the same amount because you're holding that for 45 days versus 39.
Mm-hmm.
So it practically is the same amount.
And the cool thing is, look at the strikes. The strike 3625, 3600. I mean, those aren't, really that different. I mean, you're way down there. I don't know. I mean, it's good discussions for us to have. I'm not, totally settled on it or not settled on it. I just think it adds a neat little twist to what we were doing. Because I sure don't want to just abandon what has been working. I mean, I really don't want to do that. I don't know. Good discussion though. All right, what did y'all say? Let's say John says, Sweet Bobby, using ES and James criteria was bringing 4 to 5 credit on the call side and roughly 7 on the put side. Full iron Condor was bringing in $550 to $600. So 40% of that's 220 to yeah. So I probably, you know, I didn't bring enough in on the call side. You know, I brought in $2 based on his criteria. And again, that may be because I was using probability being in the money rather than the delta. He may be using delta. So, you know, use whatever. Is James here today? James, do you use delta or probability being in the money?
Yeah, I use the delta.
Yeah. Oh, and let's thank James too. James shared his trading plan with us. It is in the written trading plans room. So let's go to his takeaways too, because Ed posted his takeaways. So here's his trading plan. So James, very, very sweet of you to do that. And I love what he says. Let's just go through his takeaways here. The strategy is 90 DTE iron condor with 150 wide wings. Bobby, why are you doing 100? Well, these accounts that I'm trading are smaller. So he started off with 100. He's now at 150 wide. So, you know, to each his own. If you got a larger account, you want to go 150, go 150. So his shorts are 10 to 11 delta on the put side, and then 6 to 7 delta on the call side. So the strategy initiated, he started on January 1st, and here's his observations over the last 4.5 months. The buying power reduction is more efficient than the undefined risk trades. And that's what James's takeaway is. He said, hey, you know, you could do naked, but I found that my buying power is really more efficient with these undefined risks, with these defined risk trades. His buying power reduction is less volatile with market movement, which is what we came out with at dinner. And in particular, number 3 is really important. The buying power effect is much less volatile with VIX fluctuations. That was our big takeaway from the entire conference, even above what Tom Sosnoff or anyone else said to me. That was my big takeaway, was what James said. Hey, the volatility didn't hurt me. Okay, so 25% to 35% buying power, point of no return of 101%. In other words, it's impossible to blow out an account when he keeps his buying power between 25 and 35%. You want to elaborate on that a little bit, James? Let us know exactly what that means. So if you're keeping your buying power 25 to 35%, you found out that your max loss on the defined risk trade is not going to blow out your account.
Correct. So, and that's where I'm at now with that buying power around 25%. I go to Tasty Trade and look at the PNR on it. It's 101. And so there's no movement I could make in testing that would blow that account out. Is there a condition that 25% would allow it? I don't know, but at least, you know, that's where I think it's at, 25 to 35%. It would take, you know, a huge move to even get close, 40, 50 points or 50%, you know, so you've got a lot of stability there in that structure.
Good. Then he says, using 25 to 35% of his buying power has yielded a theta value of 0.1 to 0.15 of his net lick. That's right where we want to be. His max drawdown was 6%. The market moved down 250 points in 4 days. So he did have a drawdown during that time of the increased volatility from 3.7 to 3.10. That's when that Volmageddon happened. So he did have a drawdown. But now when you say max drawdown was 6%, does that mean that you were up 10% and next thing you know, you're up 4%, or were you actually down 6% on your net lick on the year?
No, I was down from where I was. So I think I was printing about 9% and it come down 6% over those 4 days.
Okay. So he did have, I mean, it did have some effect on him. It didn't have the large effect that we did because we went from, let's go back to our spreadsheet, March 7th to the 10th. March 7th to the 10th. We went, let me see over here, it'll be easier to see, March 7th to the 10th. Okay, so we went, where were we? March 7th, March 10th. Okay, here we are. So on March the 6th, March 7th was our high point, right? We're at 9.65%. And we had, I mean, we went from 9% down to negative 2%. So
That's on the net lick side.
Mhm.
But the buying power, should I have needed to pull the trigger to recover? My buying power did not jump up. It might have, went up 1% or 0.5%, but it was pretty solid. So I had plenty of buying power to go do something to recover from that if it was necessary.
Mhm. So if you were at 9.65, you were at 3.65 here. Whereas I went from 9.65 to negative 2%.
Correct.
Yeah. Yeah. See, that was the difference in the volatility explosion that really took us down, that didn't take his down because he didn't defined risk trade. And that's why we were like, wait a minute, we got to check out defined risk trades, make sure that, what is characteristic of their structure that was not characteristic of the undefined risk trade. This is how this entire discussion came up. Now, keep in mind, we're not saying that what he's doing is better than what we were doing. We're just saying it was not affected as much as from a vol explosion. Evan, yeah, go ahead.
Yeah, so I've heard you mention a few times. I don't remember the exact numbers. I'm hoping you can clarify it here, James. But Bobby, you said a few times you went from being up something like $100,000 to down 50. Is that kind of correct?
I would have to go back and look. I can pull that up and look, but
Okay. So I'm
there
curious
was a
how.
swing, and it could have been somewhere in there, but I don't know. Once I got into the 100,000, I haven't seen anything below that. Of course, it all has to do with what the size of the account is to start
Right.
out with. But
Yeah, I think you were up maybe like $80,000 or something. And then during one of the times when it kept going up, I think you were down 30,000 on the year. It was at that point where you were almost tested to a point of having to close and roll on the call side.
yes, I was being
So-
tested on the call side at that time. And let me pull that up real quick here.
That's where my question comes from, because just a minute ago you were saying you went from being up 9 to, I thought you said up 9 to down 6. And I don't know how to interpret that. Did you mean that you lost 3% or were you losing 15%? Because from what I had
No.
originally thought, I thought you
So
had
there was a 6% drop
okay.
in the net lick.
Okay. So you weren't negative 6% then.
No.
Okay. I was just trying to figure out where that negative 30 or negative $50,000 came from. If you weren't negative in your net lick. So I misunderstood. Thank you.
Yeah. All right.
You're experiencing a lot less volatility for sure then at that point.
So early February, I'm looking at it here. I went from a plus 55 on February 1 to a negative 55,000 on February 2. And that, I'm sure we could go retrace that and look and see, but there were some issues with the calls. And so at that point in time, I was printing 1.37% return over a 1 month period. And it dropped to a negative 1.38%. So there was a 1% swing in one day with the calls, and the market was it was really moving above the market at that time.
James, can you look on March the 7th? How was your P and L percentage? I was up 9.65%. That was my high water mark. What were you on March the 7th? Out of curiosity.
On March the 7th, I'm showing a 6%.
Okay. Yeah. So I don't want people to think that one strategy is better than the other. I was just saying, if you are, a bit worried about a vol expansion, are there ways to help mitigate that? And I think there are, the defined risk.
And Bobby, while we're on that page, I think that's where I came up with the 6% decline, because on the 10th, it dropped to it was printing 5.92% on March 7th. And then on March 10th, I recorded that it was 0.17.
Okay.
So but then it started reversing after that and going back up.
Now let's kind of compare here, because it got even worse for me here, James, right? We on the 10th, that was not my low water mark. My low water mark came on March the 17th when I was down 4.82%. What were you on March 17th?
March 17th, 1.72% positive.
Yeah, see, so he had recovery from this point to this point, and I did not. I had much severe, I wouldn't say severe, but it was certainly going in the wrong direction from, I think, that volatility and move in the market. So, there are gimmies and gotchas, y'all. Had we not had that vol explosion, we'd probably be up well over 15% now, but it kind of took us down, and we're rebounding now. So, I think James would say, yeah, I prefer the safety. Hey, in ordinary markets, Bobby may outperform me if you're doing straight 1-1-1-1-1-2s, but as far as the volatility of his P&L, he would much rather have a lower P&L volatility by having the defined risk trades. Am I right on that, James? I think that's
what really pushed me to the defined risk is that the account was large enough that it would be, it got to the accounts at that size that, you don't want to weather a 35% decline without having some guards on. So I just slept better. And then when I started really reviewing it and figuring out that I could go one naked position or put 5 defined risk positions on and use less buying power and get more theta with 5 positions as opposed to 1. I'm not giving you exact numbers, but just so that we understand in theory, there's a buying power and theta efficiency and capital efficiency that happens. You can stack more defined risk trades together with these credit spreads than you can do if you don't put a lid on them, if you go naked with them. And that's just, I've gone back and forth on that to look at it, because I'm all about trying to be, max efficiency is what I'm looking for, along with, trying to preserve capital. And I just have found for me with that size of account, I sleep better at night. If I had a different size account, I'd probably, I'd swing for the fences.
Now, what James is going to have to contend with is he's going to have to battle on that call side a little bit more, right? We know that the market has a positive drift. He's going to have to battle some more on the upside, but at the same time, he doesn't have the left tail risk that a lot of us have that are not worried about putting trades on the call side. So his left tail risk is significantly lower because a good portion of his theta is coming from the call side. Okay, so he's going to do some battle on the call side. What he knows is the market generally doesn't crash upward and he's got time to move positions and to move things around if necessary when those battles do occur on the call side. He would rather have the battle on the call side than having excessive risk on the put side.
Well, and I will tell you, I hate the call side.
We all do.
But
Yeah.
it keeps the structure in tension. You know, there's tension on both ends. And I think that if the market crashes upward, then I've got issues, and we'll need to rapidly get out of those positions. But and I will report back. You know, what Ed posted there for me was just my observations, and that's all they are, is just observations in the last 4.5 months. In 12 months, I can report back and revise those observations, and for the better or for worse. But it's just a tool that's being described that you can have in your toolbox, and you may not even want to use it, but it's just being described and observed.
And it would surprise me if you get a return of 40%. I mean, we'll see. Time will tell. But so far, so good. I love Shovel's comment down at the bottom. He goes, I got to check this out. Up 15%. That's almost double the Shovel returns. I love that. So, James, how's this since you got back? Are you still at 15%? Or are you 16 now? Or what are you doing? What are you doing now?
I recorded today. I am at 15.68%.
Beautiful. Beautiful. Beautiful.
A little side question, Bobby. You were on your spreadsheet. I'm not sure, how are you accounting for your contributions in that column? Are they affecting your daily profits and therefore the percentage?
Yeah, you know, there's a couple ways to do that. And the best way that I can do it is this. The best way this is my P&L over my starting capital, right? My 27,853. I've got some contributions in there. The way that I can reconcile that is going over here. This actually tells me what my percent return is every month based on
Right.
yeah. So really
May
I'm up, it's like if we look through April, I'm up 4.7%. And then
May I just offer a solution that's a little bit different, but it might be
Yeah.
easier?
yeah.
And this is what I'm doing. I'm indexing my results, and then you can start from 100 for yourself and for the market, doesn't matter, or both. And then you can account for contributions or withdrawals that don't affect this. So, and I posted my spreadsheet in my room. So for anybody who wants to do that, use that, they can do it. But then you keep track of it affects, I mean, it takes into account your contribution, so it doesn't change. Your actual return is actual return, regardless of, I'm not explaining that right, but the bottom line is it's indexed to 100. You start from 100, whatever money, let's say you put 30,000, 32,000, and you put it in, but you start at 100. And if you go up 2%, you will show 102 or 2%. But then if you move money, you change the formula a little bit to account for that, but then you just continue. So you can continue adding on money, but you still end up, your starting point is 100, wherever you are. You can easily see where you are at any point.
Yeah, and I probably need to have one more column out here that does kind of index from month to month, right? And takes the starting day of the month plus or minus contributions and withdrawals and then figures it out. Yeah, I need to look at your spreadsheet, see how you did that. But the way that I go is this is really the way I do it, is this takes into effect my additions and subtractions that I put in and tells me the actual profit per month based on that information. Y'all, this has been a great session. This is a great session. I mean, I hope your wheels are turning, right? Everybody's really, really thinking, and good stuff. And James, thanks for sharing. And Evan, thanks for your questions and everyone else's questions as well. So I hope y'all have a wonderful, wonderful day. I will see y'all tomorrow.